Is a volatility trading opportunity brewing with the current debt ceiling negotiations?
The market has been very good at more or less putting aside any noise that it doesn't really want to hear. And that's been a very effective strategy over the last year or so, and it's hard to break people's habits when they've been working. The debt ceiling talks up to this point have been non-events. They've been treated that way by the market, and effectively they have been because they've been able to kick the can down the road in short increments. I do think this is changing. This one really appears to be setting up as a bit more of a political battle. Why? You've got the tax reform bill behind us, and I think the Democrats are feeling a little bit feisty about that. Secondly, you're into a midterm election year, and I think people really have to start picking sides in terms of the Democrats and Republicans and picking out their points and making a stand for what they feel will help them in November. And all that sort of is coming to a head now. It's very hard to say that something like DACA reform or building the wall is all that relevant to the stock market on a daily basis. And so at some level, the market's probably been right to ignore that. But with each day that we get closer to the debt ceiling without any real progress in the negotiations, I think that increases the risk. And what sort of risks are we talking about? In the short term, probably not that much. We've gone through a couple of debt government shutdowns in the past, and they've had some gyrations associated with it, but they've usually kind of come and gone without much incident afterwards. And so if the government has to switch to due bills or something like that, in the short term, it's probably not that big of a disruption. But a smoothly functioning short-term Treasury yield curve is very important, and I think anything that disrupts that could have some negative effects on the market. Also, if this really presages some major political turmoil for the next few months ahead, that can also have some ramifications. So what should an average investor or trader be thinking about? If you're going into this with the VIX basically having been in its, let's say, 9-ish to 11-ish trading range, you could be looking at the opportunity in the short term for a breakout. Why? There's a lot of people who have been outright shorting volatility over the last few months. It's been a very profitable strategy. It's very hard to dissuade people from a strategy that works. But a lot of these people are shorting on leverage. By definition, you're shorting on leverage. And so what you could get into is if there are a couple of hiccups, if there is something negative related to this, you could find yourself really at the wrong end if you're short of a spike. And remember, the VIX itself as an index can spike 10, 15, 20% or more in a heartbeat. There's some esoteric features to that, but the basic reason is you're not talking about the price of stocks that are moving. You're talking about the price of volatilities of options that are moving. Because it's a second order index, it's much more subject to big movements than an actual index itself. And so these are the sort of things that a trader may want to be able to either protect himself from or take advantage of. If you see the opportunity, if you feel that volatility is coming into these negotiations at what you believe to be an inappropriately low level based on the political risk that's out there, you may want to either cover a short if you feel that this is an opportune time to do so, or it could be an opportune time to dip in on the long side and play what could be a bounce in volatility as the government rectifies its own situation.